Think your dream home is just out of reach? Your credit score might be the hidden factor in you getting those keys. So stay tuned, because today we're breaking down how your credit score directly impacts your monthly mortgage payment and your buying power when purchasing a home. Happy Wednesday, everyone, and welcome to the Mojo Show. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage,
who is coming to us live from Detroit on location, by the way. This week's episode, before I get into this week, I got to tell you, I'm pumped about the intro. Okay, the music, everything that Nash helped us with. I'm loving this new intro. The music is on spot. But this week's episode, folks, we are focusing on how your credit score can dramatically affect your monthly payments and the affordability when it comes to buying a home. But before we get into all of that, of course, jump into our usual coffee talk in the morning with the Joes. As everyone can see, Cup of Joe Mortgage is on location in Detroit, in the airport, everyone. There's the Detroit
there's your fountain.
Yep. They're in the terminal. He's on location. What a dedicated host that we have and still
well,
trying to make.
I don't mind traveling, getting up early and stuff like that. But Joe, that's a question I have for you is when you're traveling, this is a good kind of coffee talk for us. When you're traveling, are you an early morning, get there before everything gets started, or you get there late in the evening the night before? Or are you one of those ones that just gets there early the day of?
Well, it used to be in my younger days when I used to travel a lot, and I would get to the airport like 20 minutes before the flight left. Right nowadays, so I like to get there like a couple hours before the flight leaves, so I can make sure I get through security, get to my gate and everything, maybe then go get my coffee, what have you, and then just kind of chill and relax. And I don't have to worry, don't have the stress about it all, because I know I'm through security. I don't have, especially now, I'm here in Houston. It might gotten a little bit better, but I hear it was the other day, it was like 2-3 hours to get through security. So,
that's what I heard too. At the Bush, I heard that there was a 3-hour wait. We have a couple of people coming up. Sorry if there's a bunch of background noise, everybody, but being at the airport, I can't tell everybody to quiet down for our podcast. They don't listen to me that way. But going out of Omaha, it's a smaller airport. I didn't have any troubles, but there's been a lot with the TSA and the shutdown and everything that they're saying. But I like to travel in early in the morning, the day before the events, like if I'm doing it for business. Yeah. And I don't know what it is. I don't mind getting up early and getting on a plane, but I feel like if I get there, then all my stress is done. And then I can focus on the things that I need to accomplish for work before the event starts the next day. Now, the other question is, when you fly, Joe, are you an aisle, middle, or window seat person?
I definitely not the middle seat. Definitely not. But if I do an early morning flight like what you did, then I want the window. Right. So I can lay my head up against and just kind of rest and, get a couple extra Z's in. But if it's during the day in that, I want the aisle seat.
Okay. Yeah, I am an aisle person. I don't care. I like to be in the aisle. Today they upgraded me up to, there's a small plane, 2 seats and 2 seats. They put me in an exit row, and I like the aisle because I can get that armrest to come up on the end. There's a little button on them that you can push, and that armrest will come up. So I like doing that because it gives me room. I didn't have that option. I was in this little tight thing. I'm glad I lost weight because I fit this time, where usually I don't fit in those. So, but that's enough about me fitting in the plane seats. But I'm an aisle person. Tina's a window person, so we always try to book window and aisle and hope nobody takes the middle.
Right.
But she usually gets stuck in the middle because I don't want somebody else sitting by me. But well, let's talk about today's show. This is a very important topic, especially for anybody buying a house or trying to refinance a house right now, is how does your credit score impact you? The first thing that we think about is, your monthly mortgage payment, your principal and interest. If you want to call it PITI, it's principal, interest, taxes, and insurance. So if you ever hear anybody say PITI or PITI, that's what they're talking about, is your principal, interest, taxes, and insurance. And how your credit affects, the whole impact is what we're going to go over today. But Joe, when it comes to, the effects of your credit score, kind of tell people, how does it affect your principal and interest payment?
It can, especially with the principal and interest, because a lower credit score obviously is going to give you a higher interest rate, right? So that can definitely change your monthly payment, which would change the affordability that you have, right? So, a higher rate is going to be a higher monthly payment, lower qualifying loan amount, and the cost over the life of the loan obviously is going to be higher due to that. So it really makes a difference if your credit scores is, let's say, a 680 to a 720, right? That's going to be a big difference in your interest rate, which is going to then change your monthly payment and possibly, make it to where you don't qualify for the home that you really want, right?
Yep.
Matter of fact, to give you an example, yesterday I was working with a client, a friend of mine, realtor that I used to work with, actually there in Michigan, Joe, working with them, and they were wanting having them qualify for a $500,000 home. But guess what? Yesterday they went and they saw a home for $525,000. Now, okay, I can't get them qualified for that. If their credit score was better, we could get a better interest rate and most likely be able to get them qualified for that, if they had a higher interest rate. So your lower credit score could edge you out of the affordability of the home that you actually want in the neighborhood that you want.
Right. And as we're going through these things, please drop comments, please ask questions, while we're going through this, because we'd love to answer them. Joe, you hit it on the head. The lower your credit score, the higher your interest rate. The one thing that people don't understand is on a conventional loan, there's what's called loan level price adjusters. What loan level price adjusters are is that's what adjusts, what the risk factors are on the types of loans we do, based on your credit score, based on how much loan to value, meaning lower down payments. There's different risk adjustments, and that's what changes up how we can price loans. And the lower your credit score with trying to do a 5% or a 3% down conventional, you're going to have a higher adjustment that we have to take into place. That is going to raise the interest rate that you're having to get. The other thing that's doing is there's still a calculation on a 30-year amortization. Well, the higher your interest, your principal is going to, that's going to increase your payment, but your principal, there still has to be a calculation for some of that to go to principal. So you have more going to interest on every payment with that higher interest rate, which makes the affordability harder for us when we're doing loans for you. So, the thing that we always talk about is how do we get you the best interest rates? And when loan level price adjusters go in, 780 and above is the top score.
Yeah.
And then they have factors that break down, right? It's usually every 20. It's so 760 to 780, 740 to 760, and so on and so forth. So the lower you go in those, the different price adjusters can hurt you, in a way of making us tell you why your interest rate is going to be higher. And everybody has those. It doesn't matter which lender you go to or which investor. Everybody has those unless you qualify for, first-time home buyer, a couple of products that are out there where you don't have loan level price adjusters, or you're at a certain area median income in the county you're buying in, to where those can get reduced. But it's still, that's how it affects your principal and interest payment with credit scores.
And I think you bring up a great point, Joe, is that the different loan level pricing adjustments, I often refer them kind of more simply for because you and I deal with that acronym all the time. I kind of refer to them as different buckets, right? So if you're in one bucket, say a 720 to 740, what's it going to take to get you to the next bucket? Because those 20 points can really make a difference in your interest rate, right? Which again is going to make a difference in your monthly payment, and again, making a difference in your affordability in purchasing a home. So I know, Joe, you and I, when we consult with clients and that on this, it could be that they have like a 736 credit score. Well, they're only 4 points off. So in consulting with them and trying to figure out a plan, how can we quickly take them from a 736 to a 740 to qualify for that next, into that next bucket, so to speak, right?
That is a great question, is how do we help people? There's a bunch of different things out there, and you can pay for what's called credit simulators. They are not exact science, right? But they do help us understand it. But, the rule of thumb is credit card balances. If we're looking at it, if I'm looking at somebody that has that 736 FICO score, and we need to get to a 740 just because the pricing's a little bit better, the affordability is better on the house they're wanting, then we're going to talk about that at the very beginning of a pre-approval stage of, hey, guys, here's where your credit's at right now, and it's based on these factors. If we pay down credit card balances and we get your balances under 30%, under 25% is usually the good kicker. If you can get your utilization under 25%, that's going to help your score. So I look at those factors on, where's those credit card balances? The ones that are really hard are those lower credit limits, $1,000 credit limit, $1,500 credit limit, $500 credit limits. When you're dealing with those, you want to use them so they don't close them. I get that. But one tank of gas can be over 25% depending on what you drive, know, so you've got to make sure you're doing the right things there. But that's an easy way for us as professionals telling you, hey, if we do this now, that means when I do a hard pull on your credit and you're ready to go under contract, now we're going to be talking about a possible better option, which is going to help you. If you're going conventional, it'll help you on other items that we're going to talk about here in a second. But on that PITI, that last I, not the last, well, the last I too, but also your mortgage insurance, which, is part of your P&I on these. The mortgage insurance is a big one that it will help you get a better rate on that. Absolutely. And it'll help you on those payments. So, I mean, I don't think I jumped forward on a topic. Well, I did.
You're okay.
I did.
Actually, before we get to the next one, because we're talking about PITI, P-I-T-I, we're talking about the principal and interest right now. Before we get to taxes, just to kind of give everybody an example of how this can, numbers wise, as an example of how this can affect you. And I'm taking a kind of a larger interest rate difference as far as a 1% higher or lower interest rate. Now, granted, going from like a 720 to 740 or a 76, that's not going to change your interest rate by 1%. Okay. But just to give you an idea, broad range here, 1% of an interest rate on a $350,000 loan or mortgage can actually raise your payment by $225 a month. $225 a month. That alone can end up raising or lowering your buying power by 40 to 60,000. So if you're looking at, a $500,000 home, well, you may only be able to qualify, with how your credit score and everything affects the PITI, maybe only 450,000, right? So take that into consideration. It really does dramatically affect your monthly payment and the affordability, your buying power when purchasing a home.
Well, and that's, Joe, you bring up a good point there. The lower the credit score, we try to go with other loan products like FHA, which I know we'll talk about a little bit too when we get down to one of the other topics. But, you can't always go FHA, because if you live in a community property state, and let's say that one person's credit is not there, so we can't use that income, we still have to count those debts against you. Well, if we have to try to not count those debts against you to get you qualified, then we're going conventional. Well, a 636 FICO score versus a 720, you're probably a full percent difference in that interest rate on something like that. So that hurts us on that affordability. But we're not trying to tell you guys these topics because we're trying to scare you. We're trying to get you guys to get with us, so that way we can help you understand it and then get you into the right product at the same time. Because that's the big piece here, is if somebody's just looking at conventional loans, those scores can really change up and hurt you from it. So.
And that's a great point, Joe, because if we can help you on this beforehand, so in other words, if it's like 6 months, I would say, 4 to 6 months before you plan on purchasing a home is probably a great time to get with Joe or I, so that we can take a look at things and see where you're positioned now and how can we improve things so that in 4 to 6 months, you're in a better financial position in putting those offers in on the home and in the neighborhood that you want. So that's a great point.
We're talking about credit scores, how, when it comes to your principal and interest, that's a direct impact that your credit score affects. But Joe, what's an indirect impact that you're seeing when it comes to credit and things on it?
That would be your taxes, definitely. I mean, your credit score isn't going to directly impact your property taxes, right? But it could kind of indirectly impact it, because if your affordability in purchasing a home ends up being lower, like we were given the example earlier of 40 to 60,000, that may put you not in the neighborhood that you want, but into a different neighborhood, right? That may have higher property taxes. I know, Joe, you and I being in Texas, and granted, we're licensed in other states, but we'll use Texas as an example. You can go from one neighborhood to the next, and you're talking anywhere from tax rate of like 1.8% to 2.5%, in property taxes. So it's not, your credit score isn't going to directly impact your property taxes, but it could affect, as far as your affordability, not being able to afford the neighborhood that you want, and you end up having to be, looking at homes in a different neighborhood that's in a different tax percentage. So
it's a very slight impact to you. What Joe is right is it could affect where you're buying. It could affect the area of town that you're looking in. That could change the tax bracket on it. So I don't want to spend too much time on that, but it can indirectly affect you. The thing that it can really affect, which is a very direct and high impact, and in Texas, we all know this is a pain right now, is that homeowners insurance.
Yeah, that's huge.
Homeowners insurance right now is the biggest thing, because there's some like Allstate right now. I don't know, Joe, if you knew this. Allstate right now is not giving homeowners insurance without bundling the auto insurance.
Really?
For first time home. Yeah.
Wow.
I just had one. Now they're still giving good rates, and I like Josh House. Thank you very much for always being there for me and my clients. give him a shout out. But right now they are having to bundle because of some of the things that are going on in Texas. So just knowing that can affect you guys, because an insurance provider is going to look at your credit. They're not going to look at your credit score directly, but they do look at a credit system that they utilize that does affect the amount of your premiums. It's not only solely on the house. So, Joe, what are you seeing with lower credit scores? What are you seeing when it comes to homeowners insurance that's affecting your clients being able to buy?
Actually, I had one just a couple of weeks ago that credit score was, not that favorable, still qualifying, right, for the mortgage, but when it came to homeowners insurance, it came in too high. And because of that, the homeowners insurance coming in as high as it did, their debt to income ratio went over the limit. And so then it didn't qualify, right? So to help that out, we did two things. One, we shopped around for other, because they were going with their current insurance provider for their auto. And so we shopped around, it helped some, right? But then we also had to go and pay off one of their credit cards that had a monthly payment that was similar to how much the homeowners insurance was being raised each month, right? So there was a couple adjustments that we had to, pivot on and make it to where it helped qualify. But yeah, it can actually, with a lower credit score, raise your homeowners insurance each month enough to where your debt to income ratio just kind of tanks.
Yeah, I've seen it on auto insurance too. Now, we don't take that into effect when it comes to your debt to income ratio, but it does take into effect for your budgeting. So credit scores really affect you in the homeowners insurance department, but also your budgeting for, if your auto is higher and things like that. I mean, heck, $900 a month in auto insurance. I've seen a couple of buyers that way because they have kids that are driving. And those kids add up, right? You have 2 kids and 4 cars, and all of a sudden you're at $900 a month. And it's ridiculous on trying to budget with that. Well, if your credit's lower, that's why. Where if you have better credit, that payment might be closer to $500 versus that $900. So there's a big difference in the way that your homeowners insurance and your insurance companies look at credit. The quality of the house, we've talked about that in the past, does have a lot to do with it, age of roof and different factors. But your credit is a big factor on that. And what Joe said was it can take your debt to income ratio too high on what you want to qualify for, or you're having to take an astronomical deductible percentage, where it's standard right now for wind and hail to be 2% in the state of Texas. Well, that's 2%. So if you have a policy that's $300,000, well, 2% is $6,000.
Yeah. That's huge.
So those are big. And so something like that can change up what we're trying to get you qualified for. So instead of being able to qualify for a $350,000 purchase, you might only qualify for a $280,000 purchase.
Right.
And there's no set thing that tells us what your homeowner's insurance is going to be. So we give you roundabouts where we see them in areas, but until we get true quotes, those can go up or down based on that.
Yep, absolutely. But there's a different type of insurance that can affect your monthly mortgage payment as well, Joe.
Yep. Well, hold on. Before we go on, we just had somebody ask or tell us, Eric McLeod. He just switched from USAA to State Farm and saved over $3,200 per year on his bundle.
Nice, Eric.
And that's awesome. USAA is a great company, so is State Farm. But it doesn't mean that they're always going to be the best. And so, Eric, thank you for sharing that, because guess what, guys? This is one of the things that we're talking about is your homeowner's insurance, your car insurance. You need to shop it every year. Don't just trust that your insurance agent's always looking out for your back. My dad was with Allstate, still is, for over 30 plus years. and he went to make a claim on the roof, and Allstate won't cover it. They don't always have your back. So shopping them means that you're trying to make sure you're staying within a budget that you need to for your family.
Absolutely.
So,
Absolutely.
something to look into.
And actually, Eric, I'm sure I'll talk with him this weekend, but I have USAA, and I've had them for a long time, and I have had a number of people, insurance agents, try to beat it, and nobody's been able to beat it so far. So even the person that I recommend to all my clients, who is an insurance broker, so they've got like over 30 different insurance companies, and they're still not able to beat it. So that's great, Eric, that you were able to find something that was going to be able to especially save you that much money. That's huge.
Yep. Now, we kind of mentioned this one already, Joe, but when it comes to mortgage insurance, this is one. Can you describe the difference between private mortgage insurance that we have on conventional versus FHA mortgage insurance? Can you just kind of hit the two highlights on those real quick?
So the main difference is that for FHA loans, your credit score really isn't going to, it's not going to affect your mortgage insurance on your monthly payment. It's a flat 0.55, right, Joe? My numbers are 0.55%, right? Now for conventional loans, they have, much like what Joe was talking about, similar to, I should say, as far as loan level pricing adjustments, very similar with your credit scores on conventional loans, mortgage insurance. So you're going to have different buckets, if you will. I'll use that example again, different buckets depending upon your credit score as far as the cost of that mortgage insurance. And there's times, if your credit score is, let's say, somewhere in the 600s, majority of the time, your mortgage insurance, your PMI, as a lot of people talk about, is going to be lower with an FHA loan instead of conventional mortgage. So it's, and that's where, working with someone like Joe and I, we're going to look at all the different products, whether conventional or FHA, to see what's going to put you in the best situation. Because your PMI, it could be a difference of $100 a month with conventional compared to FHA, depending upon your credit score.
Yep. So the easiest way to put that is conventional is risk-based pricing when it comes to mortgage insurance, where FHA loans, there is no risk-based pricing. Everybody gets it. It's very vanilla. Everybody gets the same. But you also, on FHA, you have the upfront mortgage insurance, which is 1.75% of your purchase or of your loan amount. That's added on, that's financed, but it adds to your payment because it's a higher, you're taking a higher loan amount. On top of that, you have your monthly, which Joe was saying is a 0.55 factor. We know the calculation on how to come up with that, but those are not based on any credit. It's just, that's what everybody gets.
Yep.
And then what I'm seeing is on mortgage insurance, if you're under that 700 credit score, you're really looking at an FHA loan if you're not putting 20% down, because the mortgage insurance on those start to really get to be a big difference, where your FHA, you might be on a $350,000 loan. You might be, in the $100 range, where if you have a lower credit score of a 640 or something like that, you could be $200 to $300 on a conventional with the same down payment.
Right.
So it's hard for us to try to go that route, because we can always refinance, especially in this market. Yeah. We're looking to refinance you when rates drop some more, so if it's 6 months, if it's a year to get that done, it might be smarter to take that lower mortgage insurance on a government loan versus going with the conventional, if we can do it, because of that mortgage insurance a lot of times.
Plus, when if we do have to go the route as far as an FHA initially, as long as you're on time with your mortgage payments over the next year or so, right, 6 to 12 months, then your credit score is probably going to get better. which is going to put you in a better position when we go to refinance, so that possibly then we can actually look at a conventional loan.
Right. Right.
So,
well, I know bored people enough today with this, Joe, but can you give them some helpful pointers, some high level tips that you would have on credit and, how to minimize the impact on their payments?
absolutely. So, and just to kind of recap everything, because I know we went in depth on a number of different topics on this with PITI, but your credit score really affects your payment in 3 of the 4 parts of the PITI, or principal, interest, homeowners insurance, and mortgage insurance. Not so much, indirectly, it affects the tax portion by influencing what price range you qualify for. That's why improving your credit scores, even 20 or 40 points, can really be a game changer. So if you want to see where you're sitting beforehand, I had mentioned before, probably 4 to 6 months out, it's a great time to get with either Joe or I to be able to see where you are, so that we know and can put a plan together to put you in a better financial position when you are getting ready to purchase that home. So next week, though, folks, tune in as we end up answering the question a lot of homeowners out there have, and that's what I wish I knew before buying my first home. So tune in at our usual time, Wednesday, 9 a.m. Central. Even better still, be sure to subscribe to our YouTube channel so that you don't miss any episode. However, if you did miss one of our episodes or part of this one, you want to catch up on it, go to our YouTube channel at The Mojo Show Real Estate Podcast. And of course, while you're there, hit that subscribe button, because we are on a mission to get to 1,000 subscribers, and every like, share, and comment helps us reach more homeowners like yourselves. So before we close things out, any last words or nuggets of advice for our listeners there, Joe?
I hope next week I am doing this from my own desk in my own house, besides doing it from an airport. So
fantastic. Well, I'm Joe Mortgage, and that handsome guy with a beard is Cup of Joe Mortgage, and we'll see you next week.